ahead and click record. There we go. All right. Welcome, everyone. So, thank you all for joining us. If you don't know me, my name is Naibi Kaufman Maldonado, and I am here through NALCUP. I am the program director. And with me today, we have Stephen Huell. He is the Vice President of Asset Management at Catalyst, and he is here sharing his time, sharing his expertise with us today. Without further ado, I'll go ahead and pass it over to Stephen.
Great. Thank you very much. And certainly appreciate being here. Over the next, I guess, up to an hour, I want to kind of review where we are from an economic standpoint. There's been so much in the news. I'm sure to some degree we're all getting inundated and overwhelmed with how much new economic information is coming out and how it's changing. But then also, what does that mean for consumers and members of credit unions? And then what have we seen, or what have I seen as kind of some industry trends that I hope you'll find valuable as you look at your credit union or try to digest the industry as a whole. So I've kind of got three, kind of main sections of this presentation, which I'll go through. What I'll do is I'll kind of pause as we get to the end of those. I'm going to open it up for questions, discussions, and then from there, at the end, again, if there's anything that comes to mind, just throw it out and I'll do my best to answer it. You're welcome to reach out to me after this presentation if you have something you wanted to ask or something you wanted to, run by me. I'm certainly open to that as well. So, obviously the economic environment is changing by the day, but I think if I could summarize, before I go into all the detail, if I could summarize it all in really one word, it's uncertainty. And that uncertainty does cause a lot of market volatility because we just don't know the direction. And when we don't know the direction, we're not very comfortable. And, it obviously has started, with President Trump's election and him taking the office. And the five key pillars that he is focused on, but the one that's definitely causing the most market volatility at the moment is the trade policies. And so that started in early April. Liberation Day, I believe, was April 3rd, where we imposed tariffs on well over 50 countries around the world, and so that created some market volatility immediately. But most recently, on May 12th, there was kind of a truce between us and China, and that did calm the markets. That said, it seems like we still haven't maybe come to terms, and we aren't going to come to terms immediately. But with that, with the backdrop of tariffs, it's really the uncertainty. What's going to happen with GDP? Is it going to slow down? Is it going to rebound? What's going to happen with inflation? Will that increase and then decrease? Is it possible we have stagflation, where we have a stagnant economy from a GDP perspective, but we have, increase in inflation? Is it possible we see a recession? How's the job market going to be impacted? So all of those things are causing that uncertainty, and very difficult for your members and consumers to really know what to do. And so within the kind of the economic world, one of the things we hear a lot is GDP. Well, the first quarter, as kind of predicted, it was negative. And the reason there is pretty simple. There was just a lot of pre-purchases of imports to basically front run the tariffs. We wanted to get ahead of the tariffs, so we did some significant importing in the first quarter, which caused GDP to be negative 0.3. It was, I believe, revised to 0.2 today, but negative in general. And you can see that in the orange bars, where if you go back and look at each quarter in 2024 and fourth quarter of 23, you can kind of see where we've been, roughly anywhere between 2 and 3%. First quarter being negative, though. And then if you look at the other chart, you can see it's really because of imports, as I mentioned. So that said, second quarter GDP is showing some strength. Middle of May, the Federal Reserve Bank of Atlanta forecasted, a 2.4% GDP in the second quarter. So that is a nice bounce back. So you can kind of see how it's challenging when all of these numbers kind of move around. The other one you probably hear a lot about is inflation. And there's a lot of measures of inflation, CPI, core CPI, personal consumption expenditure, core personal consumption expenditure, all of those, they tell us a little bit of a different story on the economy, but the Federal Reserve does focus on core personal consumption expenditure. And as we know, because of their dual mandate, they're focused on price stability, so getting that number down to 2% and maximum employment. Inflation, is kind of tame. It's a little bit sticky, but it's tame. Recent release here in April of core personal consumption, or core CPI, was about 2.8%. And I think the other key thing, the message that I want to hopefully leave you with today is that there isn't just one potential outcome in the economy this year. And as you can see, Goldman Sachs did a nice job with this inflation forecast where they give you kind of a range of outcomes. And I really think that's how you have to look at things this year and into next year, is that what are the ranges that we might face and how do we manage to those different scenarios? So, using their graph as an example, if we have no tariffs in that chart there, you can see that inflation actually gets to 2% roughly probably in January of 2026 and then stays there. However, if we have, tariffs and some of that comes to fruition, they're forecasting, a pickup in inflation. We just don't know which one of these lines we're going to be on. And that's really a key thing to kind of work with, is what's kind of the range we're working around. So far, the employment environment has been, remained stable. There was a lot of, concern, and rightfully so, when DOGE, was implemented. That at this point hasn't really materialized into any significant increase in unemployment. In fact, unemployment's roughly, low fours, 4.2, 4.3%. And the Federal Reserve doesn't really forecast to get much higher this year. So it seems to be relatively stable. Overall, I think the employment environment right now is still really strong, which is a good thing because it really was a concern for a little while. Now we got some upcoming reports that we want to focus on in May and June. That might give us some indication of where that sector is going. But I will say that the uncertainty in the economic environment causes businesses to be a little apprehensive about hiring and growing the workforce when they really just don't know what environment they're working in. So it could become one of those self-fulfilling prophecies where employment does go up simply because of that unknown. We don't know what direction we're going, and that does happen. So with that, there's an interesting index out there called the Baker Bloom and Davis Index, and it does kind of track economic policy uncertainty. And you can see here, going all the way back into prior to 1990, where this kind of moves and ebbs and flows. And that index hit a high watermark in May. And you can see it eclipsed the 600 threshold level, where we haven't seen that level prior. In COVID, we were below that number. And if you go back and look at some prior recessions, the financial crisis, we were half of where we are today. And so you can just see how uncertain the environment is. And here's a great, indicator that demonstrates that. And really what it does is it creates that discouraging environment when there's that uncertainty. So, the FOMC meets on a, regular cadence. And if we take ourselves back to last year, starting in September, they did reduce Fed funds by 100 basis points over the course of 3 meetings, September, November, and December. Their first two meetings of 2025 in January and March, they kind of held ground and didn't lower rates. And what we were all focused on then was, what are the minutes saying about their thinking? They're not moving rates. What are they thinking? And they do kind of, give you a little bit of insight into their thought process there. But they also release what we call as a summary of economic projections, and they do that every quarter. So that's another anticipated release from the Federal Reserve, is what is their forecast for key economic indicators in the economy. And then once we see what they're thinking, we can kind of digest what we might see for monetary policy in the upcoming year, which I'll get into in a minute. But in May, they met on May 7th. That's their most recent meeting. They didn't move Fed funds. They kept it the same. 425 to 450 is the range. And but they did note in their release that although swings in net imports have affected the data, recent indicators suggest that economic activity has continued to expand at a solid pace. So they seem to be quite content with the way the economy is going. The unemployment rate has stabilized in recent months, and the labor market conditions remain solid. And then the last kind of bullet point there is considering the extent and timing of additional adjustments to the target range for federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risk. Okay, so they're really kind of data dependent at the moment. That said, in March, and they're going to update this summary of economic projections in June, but in March, when they did their last economic release, some of the key areas of change were real GDP, as well as core personal consumption expenditure. They didn't really change the outlook for Fed funds. So they haven't used the words tariffs specifically. They've kind of danced around that word and used net imports and things like that. But they certainly have acknowledged that the environment that is happening with tariffs is going to potentially slow down GDP. So they, when compared to December, their forecast has gone from 2.1% GDP to 1.7. Softer economic output. However, they do see inflation increasing. 2.5% was their outlook in December, and now they've increased that to 2.8%. So in kind of a simple way, not to put words in their mouth, but it's kind of a stagflation kind of environment, right? Where we've got stagnant growth and we've got persistent inflation because of the tariffs. And we don't know, is that going to be a long-lasting backdrop, or might it be short-lived? That's what we need to see play out. They don't forecast more than 2 cuts. That's changing, when we look at things, and we'll talk about that in just a minute. But they basically kind of forecasted 2 cuts to Fed funds. Interesting, I'm sure you've heard a lot in the news about President Trump and Chairman Powell. In fact, Chairman Powell was at the White House at the Oval Office yesterday meeting with President Trump. And, from what was said is that he's committed to managing monetary policy independent of what President Trump says. So credit to Chairman Powell. But it's interesting how the press has really picked up, and to the extent that they're even looking at the color of his tie to see if he, tips off one way or the other, what his position is. And so it seems as if recently he's been wearing a purple tie to be, kind of independent of blue or red. And it was even asked, what's with the purple tie? And he said, I definitely wear purple ties all the time. Initially, he kind of kept it vague, and he simply said he preferred the shade, but he did need to elaborate on that a little bit. So I think that's interesting, because this is another piece that's kind of in the news a lot. And President Trump does want rates to be lower. That's one thing to understand, is that he's very vocal and he wants rates to come down. And so the FOMC does have a bit of a challenge there, trying to counteract those comments in the news a lot. And so this is a tool that you might find useful. I look at it probably every other day, sometimes every day, depending on what I'm doing. but it's the CME FedWatch tool, and they calculate the probability of where Fed funds will be, and they give you, the next 6 Fed meetings, and based on the data that comes out, and things like that, they calculate what's the probability of where Fed funds will be. So if you kind of look just last the 26th, the September meeting, what they're saying here is that there's a 80% chance, almost an 88% chance that Fed funds will be 4% or higher. So that means between, basically in September, there's 80% chance that we might have, no more than one cut. Okay. And so you're kind of getting a bit of a direction of where the yield curve is going to be. And then you can even take it one step further and move yourself out to December. And you can see that the distribution is a little bit wider. And we roughly see about a 60% chance that we'll be at 375 or higher. So at this point, it seems that we can have up to 2 cuts between now and year end. Now, this changes all the time, every day, based on the news. So keep in mind that this could change by next week. So if you, again, take and extrapolate what are the outcomes, what's the range of scenarios, which I mentioned, I think is a very key way to look at the economy. Here, when Goldman Sachs came out with their investment research not too long ago, I thought they did a very good job of kind of, presenting where Fed funds might go, depending on what happens. So looking at that graph, if we see higher inflation, it's that dark blue line to light blue line where Fed funds stays roughly the same. But on the severe scenario where there's a 5% probability of a severe recession, that would be the green line. And we could see Fed funds all the way down to 1.5% roughly. And so, again, back to not really having a clear picture of where we're going. The one thing is, it doesn't look like Fed funds is going up at this time anyway. So it seems like it's here at this level or lower. And so how does that impact you? In a minute, I will pause to see if there's any questions, but I think we can take all of that information and then digest it through the yield curve. And I think this is one of the important things in working at the credit union, is to really understand the shape of the yield curve that you are working with. Why does it matter? Because of how you choose to price deposits and price loans. And this yield curve is going to drive those pricing strategies. The short end of the yield curve is higher than the intermediate. So there's still a slight inversion to the yield curve, with Fed funds being, between 425 and 450. And then once we get to the belly of the yield curve, that 2 to 3 year point, that's when we start to see the positive slope. However, if you look at the yield curve from early January, the 26th of January, you can see that it has come down roughly 50 basis points since then. And we're going to get into pricing a little bit later. But the environment, the yield curve that you're working with right now is still elevated short part of the curve, positive slope, but we're lower than we were at the start of the year. Okay. So with that, I will just take a minute, have a sip of water, and see if we've got any questions on the economy. Again, feel free to ask anything. Nothing? Okay. Well, again, I'll make the time at the end to see if any other questions come up on any of these topics. So with that, let's kind of go into a few slides that I think give you a good understanding of where we are from, where consumers are in general. There's just a lot of talk about what is the consumer feeling. And I think the first thing that we probably all feel is a little bit of maybe negative sentiment, truthfully, because of the uncertainty. And I'm going to use that word a lot in the hour, so I do apologize. But if you look at University of Michigan's Consumer Sentiment Index, it's fallen Here recently, it's fallen to 50.8. It was 52.2 in April. This is down almost 30% since January of this year. So a big drop in how consumers are feeling, about the outlook. And the real reasons is a little bit concerned about personal finances and uncertainty over trade policies. And I think that's very understandable. We probably all feel that way. And then what's another interesting index that they include in their analysis is, what does the consumer anticipate inflation to be over the next year and then over the next 5 to 10 years? Okay. And shockingly, over the next year, consumers feel that inflation will be over 7%. And that's just, when they do the survey and get a feel for, what do you think? And then over the next 5 to 10 years, it's almost 5%. It's 4.6%. So if you go back to the FOMC's summary of economic projections, and they're forecasting inflation to be, 2.8, well, consumers think it's going to be significantly higher than that. So there's a disconnect. The consumer and the Federal Reserve, they're just difference of opinions. And if you look at the graph there, you can kind of track, what was the year ahead inflation expectations, and it really kind of shot up in early April when the tariff plan was announced, and all of the potential price increases consumers could be facing from other products that get imported from other countries. Now it's kind of leveled off and fallen a little bit since then, but that's how the outlook was not too long ago. When we go into kind of performance, asset performance, we'll talk a little bit about the industry trends, but at a big picture, I've kind of pulled three graphs to show you, credit cards and autos, just to get a feel for what's happening. And if you look at, a broader index like an asset-backed security, which again is combining all of these consumer assets into a security, you can see that credit card charge-offs have increased. And again, I've broken it down between, bank and retail. And interestingly, I wasn't aware of this until I found the research that retail credit cards really perform, much worse than a bank or a credit union credit card portfolio. So maybe they're just a lot easier to get. Maybe people, don't care so much if you're late on your credit card from Best Buy or Home Depot. Maybe you feel a little bit more obliged to pay your credit union credit card bill. But needless to say, both of them have increased. We're certainly not where we were back in that 08 range, but there has been an uptick in the charge-offs of the credit cards. And we've seen that in credit unions as well. Charge-offs, haven't performed very strong here recently because of what's happening. And then looking at the auto sector, again, credit unions are big auto lenders. And I think it's one area that we do need to kind of diversify from. But looking at the performance in the delinquencies, what we see here, and you can look at the vintage kind of all the way back to 2018, is that fairly kind of tracking trends both in prime and non-prime ABS. A little bit of an uptick in delinquencies, but nothing really that's kind of out of trend, I would say. But I think if you look at the charge-offs, it tells a little bit of a different story. The first is, the 2024 vintage has started to spike. So we're seeing charge-offs already a little bit higher than I think the historical trend has been, okay? And the other thing that I think is really important, and it's hard to change this, I don't think you can change it at this point, is that 2018 or 2019, 2020 vintage, when car values were inflated, and again, not quite COVID vintage, but close. You can see the charge-offs on that vintage has really increased, certainly in the prime, and not so much in the non-prime. but that really has to do with loan to values, the values of cars back in that vintage, and the kind of the exposure we at the credit unions faced with those inflated prices of those cars. And I think when you take a step back, I think we've all probably been sticker shocked if you've gone to look for a car in the last 5 years, and just said, well, how much are new cars? If you don't go shopping every 3 years, maybe you hear about it, but it doesn't really hit you until you go to the lot and kind of do a double take that everything is roughly $50,000, almost to get into a vehicle. But you can see here Cox Automotive trends both. The average transaction price is up to $47,000, which is substantial and is very on a monthly payment basis, that's high. However, what we are starting to see is that incentive as a percentage of average transaction price has increased. So that might be giving some relief, but again, the story still is the average car prices car prices go up, payments are going up, and the affordability for your members has deteriorated, and that's one of the main things that we're dealing with is affordability in a lot of areas. So what else have we seen kind of in the mortgage market? An area that I do feel credit unions need to, really focus. I think there's a lot of value and opportunity in real estate, growing real estate, but the challenge is where rates are. And we've been tracking anywhere between 6.5% and 7% on the 30-year mortgage. From historical standards, it's probably not too far out of line, but for recent standards and what we most recently remember is the 3% mortgage rates or sub 4% mortgage rates that we all hope come back soon and we can take advantage of. But what this shows you is that existing home sales are okay, a little bit softer than expectation, but also I think it's very challenging for first-time home buyers. And when I go and speak at different conferences or credit unions, I really reiterate that if we as an industry want to grow our membership, particularly the younger membership, this is a product that we need to offer in a way that's competitive and unique. And I'll share a story with you. I was working with a credit union in Arkansas. I think they're about 150 to 200 million, a relatively conservative credit union. And they never really offered 30-year mortgages. And they had good capital. For the most part, they had good loan growth. Maybe didn't see an immediate need. And we got talking in the last 6 months, and loan growth has been somewhat weak for them. And I said, tell me again why you only offer up to a 20-year mortgage, and really most of the volume's 15 and shorter. And they just weren't comfortable with the 30-year product from an interest rate risk perspective. And so I went through and reiterated that you've got over 12% capital, you don't really have a lot of interest rate risk, and you should really consider offering the 30-year product. And I said, furthermore, you tell me that your membership is kind of not growing, and other things like that. I said, the young borrower, the young member needs you to be able to offer them a 30-year mortgage. I mean, how many first-time home buyers can go straight into a 15? I mean, I don't know if any, maybe a very few if they're fortunate. And so you want to attract younger members, but you don't really offer the products that they need. And so we talked through that, and you know what? As of April, they're offering a 30-year mortgage. So I was very happy that they were going to do that, because I think it really was going to, kind of charge up their loan growth and hopefully attract more members and younger members, which they acknowledged they were wanting. And so, with that, Again, I'll take a stop here and see if, there are any questions on, what you think consumers are feeling, anything you've read that, you might want to share or elaborate with. Great opportunity to do that now. Oh, let me see here. Oh, no questions yet. So I just check in the chat. So, okay, so let's move on to, the credit union industry and kind of say what's happened with credit union trends. And, there's been a lot of different, stories out there. And let me kind of take you back a couple years prior to or just about COVID time and kind of lay the groundwork for how we got to where we are today. During, I guess, as we went into COVID, and there was a lot of dollars injected into the system. There was a lot of spending once we got through that initial 3 to 6 months, and rates were low, and so credit unions made a lot of loans in 2022 because rates were low, members had a lot of money, and I think we had about 20% loan growth. And I was speaking at a conference in the fall of 2022, and I kind of said, the trend right now is that we are growing loans at 20%. And, the historical high watermark has been maybe 10%, if you go back over the last 20 years. So we are double that industry trend. And so that tells you, I think it tells you one simple thing, is that our pricing is not aligned correctly. You don't just grow 20%, because we're lucky. I think we grow 20% as an industry because collectively, we just didn't have our pricing sorted out when rates fell so quickly and then started to kind of go up. And so as rates were going up, we weren't moving rates. And so we had 20% loan growth, a lot of volume in a lot of portfolio of vehicle loans. What happened with real estate is that a lot of real estate loans were made, but we sold them because rightfully so, we didn't want to retain a lot of long-term assets at low rates, but we were comfortable holding car rates or car loans at, 1.99 or whatever the rate was. And so as I was speaking, I said, next year being 2023, the risk we run as an industry is that we're not prepared for the liquidity side of the balance sheet to kind of show some cracks. Okay, we've lent a lot, but now let's flip ourselves to the liability side. And if rates continue to go up, so remember back in that time, we were getting some rate hikes prior to getting to that 5.25 Fed funds rate. Are we prepared to raise cost of funds? Do we have that figured out? So we experienced the asset side in 22 and 23. We experienced the funding side, and so we really kind of had a very interesting dynamic in those 2 years, which caused liquidity to be very tight. And so that continues to be something in some ways we're working through. In 2024, and hold on a minute, I try to move these slides forward. It probably catch up to me and move 3 at once. There we go. Okay, so in 2024, we actually, we didn't see that much growth on the balance sheet. We only saw about 2.3% growth in the assets, down from almost 6% in 23. Loans, again, we were coming off a couple of years of 20% loan growth, and then we kind of really fell flat and only grew 2.6% last year. This year, we're on roughly the same path. So fairly anemic loan growth the last couple of years. Again, in 23, it was only 6.4%. So we're down about 60% of where we were. And then again, remember, we had a couple of years of 20% loan growth. Shares were up 4.1, which is nice because they were only up 1.7 before. So last year, shares, outgrew loans, and so we improved our liquidity profile, which was critical. We had a very tight liquidity position for a couple of years there, and that was really the focus for credit unions. There's also been a little bit of kind of repositioning, I would say. Vehicle loans declined about 3.3%. We're down to about 29% of the portfolio. Real estate loans increased, but really the focus, the growth there has been in home equity lines of credit, because the first lien rates are high. So again, a lot of growth in home equity, which is good for credit unions. I think that's a great product, and we're also seeing growth in commercial, almost 11% last year. On the liability side of the balance sheet, money markets and CDs have gone up, 2%, 16%, and credit unions had borrowed a significant amount of money, and now we're starting to repay those borrowings. And so in 2024, we paid back almost $40 billion, to whoever, we could have been borrowing from the Home Loan Bank, from a corporate credit union, wherever. It was kind of a deleveraging kind of year, as well as a repositioning of the loan portfolio. But what we did experience, as the prior slides have shown you, was the increase in delinquencies and charge-offs. Delinquencies were up about 21% to 97. Charge-offs were up 36% to 80. Combined, we're at almost 1.8%. And that's a significant jump from a couple of years ago when we were over, just about 1%. So, again, from what we're used to, we're probably not feeling too good about that. But when you look across the industry and how credit has performed for consumers, it's not really surprising. Okay, there's been obviously a lot of credit extended the last couple of years, and some of it is just not going to perform. What we have seen, which I'm really proud to say, is the asset yield, or the average yield on loans has increased. We're almost at 6%, and we're not quite there. We're at 583, but we're well above 2023 when we're at 5.24. So I think that's a great story right there, is that we have been increasing loan pricing. And this will something I talk about shortly, is where do we go from here. But we've seen loan pricing go up, which is what we needed to do, because cost of funds went up roughly 50 basis points. That said, we were able to get that net interest margin a little bit wider, over 3%. And that's really important. That 3% is kind of that number you want to get for net interest margin. We just got over 3.12%. ROA, a little bit of a soft year for 2023. I think 23 and 4, we're in the 60 basis point range. And this year we're tracking very similarly. So I think we're going to be anywhere between 60 and 70 basis points on average. But we've been able to see our net worth ratio go up. So prior to COVID, we were over 11%. It took us a couple of years to get back over 11%. We're a very well capitalized industry. Sometimes you think maybe we got a little too much capital relative to the risks. So there's always opportunities there to find ways to be creative and return that in some way, shape, or form to the membership base. I like to kind of give you a little bit of a feel for different states. And so NCUA does a great job of mapping out the credit unions by state, and they put a few charts together. Loan growth. Again, I'm in Texas, so unfortunately, we didn't have very strong loan growth, anywhere between -1% or less. You can see there's probably a handful of states that got over 2%, and the rest were in between. So again, a soft year. There's no secret potion out there, or magic, dust that we can sprinkle. I think it's just very unique. Delinquencies on average, again, about 70 basis points. And you can kind of see where there were some high levels of delinquencies, what states really didn't have a lot of delinquent loans. And then looking at the liability side, again, looking at Texas, relatively weak for deposit growth at anywhere between -2 and 0%. We're in that same color code with probably another 10 other states or dozen states. And then we've got 3 states that got greater than 4%. Interestingly, I'm not really sure what would drive too much growth in Wyoming, South Dakota, or Maine, but regardless, they were kind of the leaders in the deposit growth area. And previously, if I could ever say, if I was able to ever observe a trend, it seemed to be the Pacific Northwest, had a couple of years of some very strong balance sheet performance, deposit growth. I think the Pacific Northwest is very well supported from a credit union and membership perspective, and they seem to do well through different economic times. And then just return on average assets. Like I said, the average was anywhere between 60 and 70 basis points, and you can see what states would have performed stronger than others here. A couple outperformed at greater than 85%, being Idaho and Vermont. But other than those two, for the most part, it was below 85 basis points. And so I think before I'm going to kind of get into the last section of the presentation, certainly if anyone's got questions on how their credit union has performed, or maybe within the state, maybe you look at peer trends that you try to reconcile, and maybe there's some numbers that you don't quite understand how they could get to that number. I'm certainly willing to take a stab if you've got something of that nature to ask, or if you even want to know, roughly how do people use PeerStats. I kind of see it as there's pros and cons to PeerStats, because I'll just say that I think every credit union has a different DNA, which I think is phenomenal. I really like going to see credit unions and understanding what is their mission and strategic objectives, and how that you can be very unique in those strategies. And I think that's why PeerStats don't always make sense, and they shouldn't always make sense. That said, I think we find comfort in big numbers and that kind of pool of data. So we kind of gravitate to, well, what's the peer doing? What's our neighbors doing, and stuff like that. But just be mindful. It doesn't, and be very mindful, I think, when you share some stories with the board, because it doesn't always tell you their strategy, and their performance can be somewhat misleading relative to yours. So just be careful with that.
Stephen, we do have a
Yes.
question on the chat.
Yes.
It says, what might be credit union trends moving forward under uncertain times to add comparative advantage from other financial institutions, and in particular, non-financial benefits necessarily?
Mm-hmm. So I think what the trend is going to be is I think in general there's still some uncertainty within the structure of our balance sheet, and it's getting everyone comfortable again with the environment we're in. And when we go from one rate cycle to another, I think there's always kind of residual questions and doubt about, did we do it right last cycle versus how should we do it now? And I think that's kind of one thing I've observed with credit unions, is really the uncertainty of how should we map out our future right now, our next year. And I think what I would say, and I'll get into a little bit of this, is I would be competitive on real estate lending, to the point where I have encouraged credit unions to be potentially a little bit below market on rate, because you might be able to buy yourself some prepayment protection. Let's say I talked to a credit union and they were going to be about 5 basis points below their competition. I said, well, have you thought of being 50 basis points below your competition? Like, really trying to get some volume, and realize that, hey, if you're making a loan at 650, that's still a very good loan rate. You don't have to be at 7, just to feel comfortable. So I think, what is the outlook? I think if credit unions can get their heads around pricing, I think we could see some good loan growth, and I think we've got opportunities to be competitive and grow real estate volume. For, I think the second piece of the question was a little bit around non-financial. I think you have to be there. I think your members are definitely in need of you right now. I would say more members are probably experience financial hardship than we really know. And I think we have to be in tune to that and making sure that we are there for them and understand their needs. It's a little bit harder to do than to say, but I think that's really important. So hopefully that gives you a little bit of kind of an indication of what I'm thinking. So I think on that note, I think loan pricing is critical, as it always is. But remember the key that what I say is the three key pillars: quality, profitability, and growth. They all go hand in hand. Regardless of pricing, a bad loan is a bad loan is a bad loan. It's just you're never going to return what you might lose. You've got to be able to price appropriately to cover expenses and generate your return. And all of that's going to drive growth. I mean, if you're not competitive because your rates are, too tight, you won't see any growth. And you might need to adjust. And if you say, why do I have 20% loan growth in this category and everyone else only has 8, maybe you're not priced appropriately. So with that, some very simple methodologies that I like to share is kind of 3 kind of ways to look at your pricing. You can be kind of a cost plus methodology. You could be a price leader, or you could be risk-based. Okay, and you have to understand which one of these are you, and is it working? So when you think of cost plus, you're really taking, it's a relatively simple. You're going to look at the treasury curve. That's why I showed it earlier. You're going to add on, your funding costs, your operating cost, risk premium, and your profit margin. You're not really going to focus on competition too much because you're building your internal model based on cost. It's simple. It's a little internally focused, but it works, and a lot of credit unions do that. You could be a price leader, which I think we are in this industry, probably more than not, where you're looking at external market. It's simple, but you're going to be kind of externally focused. But the key there, and it can work, but you've got to be able to, because again, if it's not very thorough, you've got to make sure you've got low cost of funds and low operating expenses. And some credit unions can do that. I mean, I know some credit unions that have a competitive advantage based on their SEG or whatever it is, where they don't have a significant amount of operating expenses and maybe don't have building expenditures and things like that. That can work. And then risk-based is going to be a little bit more dynamic. You're looking at break points and default premiums and things like that. So I think it really comes down to knowing your methodology and has it performed for you. But here's a simple example of what we've experienced in pricing. If you go to NCUA, they've got a great, I look at their rate survey every quarter because they do post it, and it's good information. It's high level, but I think it's a good starting point. You can look at where is the average loan yield for credit unions, where's the average loan yield for banks. And so let's just walk through this table just to kind of give you an example. Last year in June of 24, they did their rate survey showed used car loans at 6.42%. In March of this year, we're down to 5.93, so we have lowered rates. We're down about 49 basis points. The treasury curve has gone from 475 to 388. So that's a drop of 87 basis points. So the curve's dropped 87, but we've only dropped 49. So that means in theory, our spread is wider by 38 basis points. And that's kind of the key, is you've got to kind of get down to your spread and where is it relative to your pricing index? And, are you seeing widening spreads or tightening spreads? And that will directly roll up to your loan yield and net interest margin. And if you can take, the one that's probably going to be the least customized is going to be that 30-year fixed rate mortgage, because for the most part, it's always set off like a Fannie Mae or a Freddie Mac. So, you can kind of see that moves a little bit more at a national level versus regional or your own pricing matrix. But you can see we've gone from 697 to 668 on our rate survey from NCUA. The treasury curve has only gone down 19, so we've seen spreads widen in there by 10 basis points. Spreads are wider in mortgage product. Another reason why I encourage you to look into that product offering and see what's your capacity to add that to the balance sheet. Um, and then I think with autos, I think there's always room to data mine your portfolio and look at it in a lot of subsets. So, what's new and used, what's direct and indirect, yield and maturity, loan to values, credit distribution, and migration. There's a lot of data mining you can do. They're normally bigger portfolios. One thing, I know because I've asked large and small credit unions whether they can kind of produce the data is loan to value migrations and trends. And I think we're getting better at that, but probably not experts at it just yet. And meaning we know what the loan to value is when we make the loan, but how has that changed over the course of a year? What's the cumulative loan to value on your portfolio, and what kind of risk is coming within that portfolio? And so just really doing a deeper dive. And I'll share with you here, an example of a credit migration spreadsheet that I actually was talking with a credit union at one of their ALCOs, and I explored this topic with them. And they weren't doing it at the time. And then after our conversation, they said, our system is robust enough that we can generate this kind of report. And I said, excellent, generate it, and you guys should be talking about it at each of your ALCOs. But it's very simple. It's just, here's kind of a breakdown of the balances within your loan portfolio, within this credit union's loan portfolio. And you can break it down by, tier A plus all the way to E, and you can figure out, how much is migrating, how much is staying the same, how much is improving. You don't always see a lot of improvement, but you kind of see a stay the same or migrating down. And so it's just getting a feel for that portfolio. And the one thing I think we are doing a lot better job of is data. I think it's, and back to that question, I mean, really, that question that was just asked not too long ago is what might we see in non-financial areas? And I think data is that one area that we are improving upon, but it definitely is the future. How good are you at looking at those analytics, being able to data mine your balance sheet, your portfolio, and be able to have meaningful conversations around what that tells you. But we're getting better at that. And that's one area I would definitely encourage you all to try to enhance at your credit union is data analytics. And we're going through some interesting projects at Catalyst, where I oversee asset management. So we do a lot of consulting, but there's a lot of data I want to look at when I talk to a credit union, and we're really putting some energy into that area to get a deeper perspective on data. And then with real estate loans, I think what we found is that I think credit unions are becoming more diversified in their suite of products. I gave you an example earlier about a credit union that didn't offer a 30-year mortgage. They do now. I'm happy about that. I feel like I was a part of that strategic initiative, and I think it's going to be good. And I hope it helps them grow their membership base. But looking at what products do you offer, and do you feel you've got that product suite that's going to make you competitive? Everyone's got a bit of a unique strategy here. I've got some credit unions are doing, lot loans all the way to construction and hopefully capturing the sale to the borrower. And then I've got others who do a one-time refinance with no fees. Everyone's kind of got a bit of a unique strategy out there. There's just, minimal, or lower closing costs. There's way to be creative. And that's what I think you need to be able to do right now is be creative. If you find, based on size and complexity, that interest rate derivatives are a tool for you, that's a growing tool within the industry for sure. And then again, I think, just staying on top of delinquencies. How strategically can we improve that? I think it's just, contacting your members sooner, sending out that first attorney letter within 30 days, really having borrowers be specific about their repayment plan. looking for lapsed insurance. My goodness, insurance on cars and homes have just gone up so much in the last couple of years. Keep an eye out for that. That is, that added financial burden that our members are experiencing. We're all experiencing. Being on the lookout for higher debt to income and loan to value on new originations, and be proactive. Follow up on those areas. And then, the last slide I'll leave you with before I open it up for another question or two is really on the funding side. And I think this is an area of dire focus for our industry, for the community bank spaces. How can we grow core deposits? We know we can grow them if we put a great CD special out there, but how are we going to grow them naturally? To always feel like we're going to get a good growth in that area. So be mindful right now. Don't lower too quickly. I think you've got to understand your liquidity position. Looking at the pricing between your tiers and balances, we've got credit unions who are really evaluating that right now. Did prior pricing strategies work or not? Did you cannibalize your own deposits and just drive up costs? What's your optimal funding duration? I don't know how often we really talk about that or quantify that based on where your asset duration is. So know that. And then do your share projections align with the personal savings rate? I've talked to credit unions and they'll give me, we're going to grow shares by 10% this year. And I thought, okay, well, the personal savings rate is forecasted to be 4. So how are you going to make up the difference? I mean, you're going to have to buy the difference, right? You're going to have to buy it through rate. And so has that strategy been properly articulated? And then, make sure you do model scenarios and look at that. And that's one thing. And in fact, one of my advisors this week was working with a credit union who wanted to introduce a new money market tier. And so they sent over kind of quite a detailed spreadsheet of potential moving balances of members and looking at the cost of kind of those things. So do that modeling, have that ready for your examiners. So I think, given all the uncertainty, I can say also that I think we're going to be busy. There's just a lot of things to consider and do. And so, I'm going to leave you here with about a minute or two. But with that, I will open it back up to any last questions. If you don't have any, you're free to reach out to me if you have some, and then we can talk. But with that, I'll turn it back to you, Nahibi, and right there at the 1 hour mark.
Yes, thank you so much, Stephen. We do have a couple of questions on the chat.
Okay.
First, we have, what are your thoughts on credit unions partnering with fintechs to build up the balance sheet for auto and RE specifically?
Right. I think there's definitely a lot of channels to do that. And I would just say, do your due diligence. Make sure you understand the risk you're taking. You can definitely get volume. You can definitely get volume that way, because I know credit unions have done it, but I've also known credit unions who've experienced higher levels of charge-offs in some of those programs. And so do your homework there. But I think there is opportunity, and there's growing fintechs in the industry. I think there's some really creative and exciting ones out there, and so opportunities, but just do your homework.
Thank you. And the next one, how do you see the commercial side contributing to credit union growth and risk management? Are there specific asset classes you believe credit unions should focus on?
Well, commercial is a growing area for sure, and I think for good reason. I think it's an untapped area, at least on the deposit side. I know numerous credit unions that want to expand their commercial deposit products, and I think that comes with having that comprehensive suite, and so that's important. And I think there's areas of growth there. The commercial side, I think there's good opportunities there. Just be mindful, and again, back to that due diligence and the underwriting. Just make sure you know what you're getting into. And the other thing with that is, for the most part, they can be fairly substantial loans, right, in size. So it's not going to take more than, a few to get a good rhythm and growth path, built. And so I think you need to ask yourself is, are you intending on portfolioing these loans? I mean, some of them can be multiple $1 million, or are you looking to sell a portion of those? So do you have that piece established where you have some ready partners that can take on a percentage of those loans, or do you intend on portfolioing the whole piece? And if so, what does your concentration look like, and looking at things like that. I think there's definitely been a focus there the last 3 to 5 years. Maybe we've grown a little too fast. I don't know yet. The jury's still out on that area. But just be disciplined in that area, because they can be larger loans, a little more risk.
Thank you so much. Are there any other questions from the audience? No? Okay.
Okay.
Well, if there are no more questions, I'll let you free to enjoy the rest of your Friday. Thank you so much, Stephen, again for joining us on this amazing webinar. It was super insightful, and we really appreciate it.
Great. Thank you all. Thank you so much. Have a great weekend.